Hey everyone, welcome back to the channel. If you're a longtime follower of the channel, you'll know that a significant portion of my stock portfolio is in Pershing Square Holdings, which is the hedge fund run by Bill Ackman. A while back, I did a detailed breakdown and had a great conversation with Karan Gurnani where we talked about Pershing Square, all of its individual holdings, its individual stock holdings, since it's a very concentrated portfolio that Bill Ackman runs. I'll include that link in the description below if you want to check it out, but we recently got a new update from Bill Ackman himself in an interview that he did for the Wall Street Journal's Future of Everything event, where he dropped this bit of information.
Well, I could do it right here if you'd like. I know
that would be great.
Journal likes announcements. So we sold Starbucks, which is really an amazing business, largely because it got to a price that was hard to earn the kind of excess returns we like to earn over time. You know, Kevin Johnson's done an amazing job. The team's done an amazing job. It's really a great business. But the stock just recovered too quickly, too fast. And I think investors will do well with Starbucks. But for a very brief moment, another restaurant company that we followed very closely over a long period of time dropped dramatically in price for reasons we didn't understand. And we were able to swap Starbucks for Domino's Pizza.
So there you have it. Bill Ackman and Pershing Square Holdings have dropped their Starbucks position, which at the time was about 10% of the portfolio for Pershing Square, and have replaced it with Dominos Pizza. And Bill Ackman says they own about 6% of the company right now. So a very significant investment into a pretty large company. As you heard Ackman say, Starbucks had risen to such a high price that they were very comfortable selling it, given that it basically recovered to what they would have probably hoped it would have recovered to even a few years from now. So they're plenty ahead of schedule, decided to just take the profits there rather than risk another dip and move it into another quality business, which in this case was Domino's, at least according to their calculations. And as a point of reference, Domino's has a market cap of about $16.5 billion, which is certainly much smaller than Starbucks, which has a market cap well above $100 billion. So a much larger company switching into a smaller one, but certainly one that has seen tremendous growth over the last few years and is a more predictable business, which is the kind that Bill Ackman goes for consistently. He wants to find businesses that have predictable cash flows with a decent trajectory for growth, the very Buffett style sort of investment. That is his core value philosophy when he's trying to find investments. Now, he does have more of an activist reputation where he might come into a company, switch out management, bring in different connections and try and change a business in some way, maybe create a spin-off, wherever he can provide value that way. That's the activist part of his regime, but otherwise he really is a value investor in the more traditional sense. Clearly, he likes the predictability of the Domino's business. It's a very simple business model. It is pizza restaurants. It's selling pizzas. That's it. It's not very complicated, and it's a franchise model as well. And Ackman explains a little bit more about this and why he likes Domino's and why they actually made the decision to invest in it.
One, obviously, we like the restaurant industry. Interestingly, we've never lost money in investing in a restaurant company. I think we've never not made a lot of money.
And just to remind people, you own Burger King's holding company and also Chipotle.
Yes, so it's a space and industry we know and we like. Domino's is a pure franchising company, and interestingly, they were really first and best in sort of technology and delivery, and they own their own delivery infrastructure, so they don't need to rely on the DoorDashes and Uber Eats of the world, and that is actually an important competitive advantage in a world where you want to you can deliver pizza for $7.99. It's hard to do that with a delivery service taking, massive cut of the proceeds.
So I actually want to highlight that important point there, that Domino's actually organizes its own delivery structure. Even though the restaurants are individually franchised, there still is some centralization with the actual delivery process, which Ackman sees as very valuable, and it certainly makes sense. You don't have this sort of third-party outsourcing that you have to rely on where you're going to lose profit, or it's going to be more expensive for customers and thus less attractive for customers to buy if they have to use an expensive third-party service. Instead, Domino's manages that stuff in-house and keeps it very organized in that way. That's pretty much all I can say about it, since I haven't done much research into the nuances of how Domino's system actually works, but that's clearly something that was attractive to the Pershing Square team.
So it's an extremely well-run company. They've done an incredible job on everything about the way they run their business, to the way they grow their business, and to the way they allocate capital in their business. So it's real standout. We've admired it for years, and it was always never cheap enough. And then for about 5 minutes, it got cheap. I don't know who sold or why, but we started buying around $330 a share, and then it very quickly moved up a lot.
So you heard that they started buying at about $330 per share and probably bought above that as well. But as a point of reference, the current share price for Domino's is around $420. So that's the big update. Pershing Square says bye to Starbucks and hello to Domino's. That's the big change. In the interview, he also mentions that they're probably getting close to a merger with the Pershing Square Tontine Holdings SPAC. Not too sure yet. It's a very complicated process, he says. I actually plan on talking a bit more about that in my next video, so be sure to subscribe so you don't miss that. But the reason the Pershing Square Tontine Holdings SPAC matters for Pershing Square Holdings, the hedge fund, is that Pershing Square Holdings is the actual sponsor for Tontine Holdings, the SPAC. And Pershing Square Holdings has a bunch of warrants for Pershing Square Tontine Holdings. So if Tontine Holdings gets a great deal, that would inherently mean that Pershing Square Holdings should be getting a great deal too, since they're the ones that have massive upside benefit potentially because of those warrants. But they got to get the business at a good price and keep it over about $24 a share. That's where the warrant price is. Ackman also mentioned the importance of having a business that can protect itself against inflation, especially in this environment. He mentions it later on in the interview. Since in an inflationary environment, costs go up. And if costs go up, the only way you're going to maintain your profit margins is if your prices can go up too. So having a business with pricing power, which Domino's seems like would fit that bill very much, they can raise the price of pizzas very easily if their input costs go up. That's very important for protecting yourself in an inflationary environment. But the first step in Ackman's analysis is to find a great business. And they think they found a great business with Domino's, one that hopefully would have a strong trajectory for growth and should bode well for Pershing Square if all goes according to plan. You never know what the future might hold, of course, but I'd love to get your guys' thoughts in the comments below, so definitely leave them down there. But anyways, if you like this video, definitely like it since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe since I put out new videos every single week. Wouldn't want you guys to miss out. And check out some of those affiliate links in the description below. That would also help the channel out a lot. And I'll also include a link to the full Wall Street Journal interview in the description below if you want to check that out. But until next time, take care.